Summer in traditional finance is usually a ghost town. Liquidity dries up, traders vacation, and massive institutional shifts rarely occur during the July lull. Yet in a single day this July, $203 million in net capital flowed into U.S. spot Bitcoin ETFs. This wasn't a one-off spike. It peaked a 6-day consecutive inflow streak for Bitcoin, alongside a 3-day streak for Ethereum, adding $37 million. These flows aren't from reactive retail traders. Capital is moving from family offices, registered investment advisors, and funds, entities trading with method and patience. These institutions are structurally bound. They are required by mandate to use regulated wrappers to access digital assets, rather than holding them on-chain directly. The persistence of these summer flows points toward a structural layer of demand, the kind of methodical accumulation typical of the professional allocators now entering the space. To see what's actually happening, we have to look past the daily flow numbers and look at the financial architecture absorbing this capital. This diagram shows the ETF wrapper, a secure bridge allowing traditional capital to bypass direct ownership volatility while staying regulated. This bridge is only one part. Real-world asset tokenization has surpassed $20 billion on-chain, creating multiple new pathways. Major firms are now moving settlement infrastructure, like tokenized U.S. Treasuries, onto the blockchain, shifting the focus from speculation to real-world utility. Between ETF inflows and the growth of tokenized assets, we are seeing a shift in how global capital accesses the digital asset class. But why does a multi-day Bitcoin ETF inflow streak today mean something different than it did 12 months ago? The difference is what analysts call adjacent plumbing. As this cross-section shows, the market foundation has been reinforced by layers of institutional custody, prime brokerage, and tokenized collateral. This thicker plumbing increases the ecosystem's depth, allowing it to absorb sudden outflows or market shocks that would have caused a break a year ago. While downside risk remains, the scale required to trigger a market-wide panic is now significantly higher. This increased depth acts as a stabilizer, preventing sudden reversals from rattling the broader market even when summer liquidity is at its thinnest. The ecosystem has evolved into a reinforced structure designed to handle the weight of institutional-scale volatility. But this structural expansion is not operating in a political vacuum. In Washington, banks are actively lobbying to alter major crypto legislation just days before a critical Senate vote. This contest could reshape the regulatory framework that currently supports the spot ETF structure. This creates a regulatory fork. Institutions must decide if ETFs remain their primary access point or get overtaken by flexible on-chain instruments. These massive flows represent strategic positioning ahead of that fork, securing access through existing vehicles before rules change. If the legislative outcome is unfavorable and the inflow streaks break, we will see if this new allocator base has staying power to hold their positions. For now, anyone dismissing these streaks as noise is overlooking a clear signal. The volatile playground of the past is being overlaid with the heavy infrastructure of Wall Street.